YouTube, what it do? It's your boy Little Petty checking in with you guys with another stock market episode. All right, you guys, and today we're gonna this is gonna be part 2 of the lesson, and the video is called "How to Sell Options in a Small Account for Income" Part 2. So in this video, I think it's gonna be a three series video. I'm dropping a lot of knowledge, and it's hard to get all the information in at once, especially on these beginner videos. So without further ado, let's go ahead and jump straight into this lesson. So, whoops, I keep doing that. All right, so in lesson 1, we talked about what are options, how do they work, what are some of the advantages. We also talked about how to trade call and put spreads. We talked about debit spreads and credit spreads. Now in this video, we're going to review a couple more things about the debit and the credit spreads. I did go over a little bit brief, but I do want to touch a little bit more on the debit and credit spreads. So the debit spread, let's go ahead and pull back up the formula. So the debit spread is a contract long minus a contract short, and the strike width minus the debit paid is going to be your max gain. So when we come back over here to the option chain, a debit spread is basically you're going to buy one contract depending on whatever strike that you want to pick. So for instance, let's do it like this. Let me pull up Apple. Let's go back to that Apple. Alright, so there's a bunch of ways you can do debit spread. You can do a call debit spread, and setting up a call debit spread is a bullish play. So if you're bullish on Apple stock and you wanted to do a debit spread, you can do a so let me rewind. There's different ways with options to take advantage on bullish plays or bearish plays. Now with the bullish play, you can do a debit spread. You can also do a credit spread. It all depends on how you set it up. If you do a call debit spread, that means you're bullish. If you do a put credit spread, that means you're bullish. Now if you did a call put spread, that means you're bearish. And if you did a call put spread, that means you're bearish too. So let's break all that stuff down. I know it sounds like a lot of gibberish, but it's options, and it just give it some time. All right, so Apple is trading at 127. We are bullish on the stock. We're going to focus on bullish. Stocks usually go up, so we're going to focus on bullish. Now, a way to set up an option, a way to set up a debit spread, we talked about in the last video, but we're actually going to buy a strike. You can buy a strike in the money. You can buy a strike out of the money. Now, preferably, we usually like to do an InOut Spread, or we like to buy on a bullish play. We like to buy outside of the money, and we want to get into the money on a debit spread. So, for instance, with Apple trading at 127, we're actually going to want to buy whatever strike we're going to want to buy. So, say we want to buy the 130, and then we sold the leg outside of that, the 131 or whatever, the 135, depending on the width. We talked about that in the other video. I'm not going to get too deep in that. So, but setting up a bullish play, a call debit spread on Apple outside of the money, it's going to make our risk cheaper. It's going to make our risk cheaper, but our probability of getting in the money is going to be lower. Now, when you're holding the debit spread, it's all about at expiration. That's where you're going to be able to collect the max gain. Now, as the stock goes in your favor, if you actually pick the right direction and the stock's going in your favor, we paid the 32 cent for the play. Now, as the stock starts going up, this premium is going to start going up. That's going to be your profit. That's going to start going up as it gets closer to the money. Now, when it actually gets in the money, and then when it gets closer to the expiration date, it's really going to start ramping up. At or above. Cool. So it's really going to start ramping up. The options are actually going to increase in value. Now, a debit spread is, let me go back to my notes real quick. Boom. So that's a little bit on the debit spread and some of the advantages. So the reason that we would want to actually do a debit spread is for one, say let's go to Tesla. This will be a better example. All right, so if we wanted to do a debit spread on Tesla, if you wanted to actually come out here and just buy a naked option, which you would learn through other channels and stuff where they actually just teach you how to buy a naked option. Now the risk with that is you're paying a higher you're paying more capital. So with the debit spread, the way you can take advantage of, say you don't have this $4,000 to buy this 35 call strike, but you're bullish on Tesla stock. You're bullish on Tesla stock. You don't have $4,000 in your account to buy a naked call right at the money. You don't want to buy a crap contract out here because the delta's only 17 and it's not going to move. It's going to move, but you don't want to buy these cheap contracts because it's not in your favor. This is how you blow up your account. So you don't have the $4,200. You want to play right at the money. So you go ahead and you buy a debit spread saying, I believe Tesla is going to go past this strike that I'm going to actually buy and sell. So for instance, we're looking at Tesla and we're saying, yeah, we want to buy a debit spread right in this zone. We think in the next, we can even go for 3 days. We think in 3 days Tesla's going to be above this zone. Or we can say it's going to be above this 650 zone, in 5 days, the next week. So December 24th, we could come out here and we can play the 650s and the 655. Now it's a $5 width. And remember the formula we talked about when you do the subtraction. This is going to be the debit that you're actually going to have to pay to get into this play. So you're actually only going to have to pay $225 plus commissions to get into this trade for a max gain of, let's pull out the calculator, 500 minus $222 for a max gain of $278. Now you cannot make any more than that because you actually sold a contract on the call side. But that is what the spread is. So you're actually capping your gain and you're minimizing your risk. You're not going to come over here and say, I'm going to buy this 650, put up $3,600. If this backfires against you, this could go to zero. You could lose this whole $3,600. Now, if you sold this, the max that you can lose is $227, but you still have the potential to play the price action on Tesla stock. You believe that Tesla stock's going to go higher? Okay, you come over here, you get a debit spread, a call debit spread outside of the money, or you can go closer to the money, and the closer that you get, the more that it's going to cost because your option is closer. So an in-out spread, we'll talk about that later. Debit spreads. Now, you could actually sell a debit spread in the money. You could say, okay, we want to sell this 620 and this 625. We're going to pay about, it's probably going to fill you at about $2.60. So $260. And as long as Tesla stock doesn't drop below here, your max gain by the 9th would be 500. Would be 500 minus 26, $260. So you would still walk away with this $240. And all that you needed in the account was $260 to buy this debit spread in the money. It'd be the same as basically selling a put credit spread outside of the money. So same flip. You're selling this, but actually you're gonna buy it. And when you're buying debit spreads, we'll talk about this too real quick. When you buy debit spreads, you don't have to pay to close out the trade if the trade backfires against you. With the credit spread, you have to close out that trade regardless. It's either going to exercise at the expiration date to worthless, you'll get your money that following Monday, or if you close it out on that expiration date, then you'll get to collect that premium, and then you'll basically give the contracts back. Now with the debit spread, the reason that we say to do debit spreads outside of the money is because if the price doesn't get to your strike, you don't have to close this out. You're not going to have to pay to close it out. Sometimes when you're deep in the money, like this, for instance, if you sold some Tesla 700 calls, you're deep in the money. This is a $10 width. Let's actually go deeper. Right here, you got a $10 width. You're gonna have to pay it $15 to actually get out of this trade because you sold something. You sold something that you didn't own, and you have to buy it back. That's what you're doing. Now, if you bought something and it goes to trash, you don't have. It just goes to trash. You don't have to go replace that contract. It just went to trash. So I want you guys to understand that. The debit spread, you're buying the contract and you're selling one, but you're basically buying the play. On the credits, so this is the debit spread right here. You buy one and you sell one at the top. The credit spread is you sell one at the top and you buy one at the bottom. You can do it on both sides. So say if you wanted to do a sell a call, selling a call would be, we think that the stock is going to go down. We think the calls are going to go to nothing. So we would actually sell this and then we would buy that. Boom. And we would receive a credit for $288 and we would have to pay $700 to collect this as long as Tesla does not get above 660. All right, that's a pretty good breakdown right there for the debit spreads. All right, so selling naked versus selling a spread. So we kind of did talk about that. So selling naked, you're actually going to need a lot more collateral. You can sell naked puts, but you can't sell naked calls unless you have a pretty big account. So the reason that you can't sell naked puts is because you can sell naked puts, but you're gonna need a big collateral. So if you wanted to sell the 605 to collect this $1,200 to say that Tesla's not going to go down, you need a collateral of $22,000. The reason we buy spreads is you actually get to buy that leg. You reduce your risk, and you can have a smaller account to actually collect the premium. It's a safer trade. So why sell a credit? Why sell a credit call and a put? All right. So the reason, like we said, the reason we want to sell, the reason we would like to sell credit spreads is if we are either bullish or bearish on the stock, we're neutral on the stock, or bullish or bearish on the stock, and we want to take advantage of the premium of the options that are outside the money. So for instance, Tesla stock today, a lot of investors, they were selling $700 calls that expire on Friday. A lot of investors don't think Tesla's going to get to 700 this week. So what they're doing is they're actually coming over here. They're selling them naked. And let's actually pull this up real quick. Let's look at this chart real quick. Let me pull this right here. All right. So this is the option. This is the price of the option. I need to get a better time frame. 1 hour. All right. So this $700 call on 2 days ago, it was trading at the high $1,700. Now investors, they were selling these options because with the time decay, as long as that $700 call doesn't get in the money, Tesla price needs to get to 700. These contracts are going to bleed out. So they're actually selling these calls and they're collecting that money. When these calls go to zero, they got basically just to keep that money. So since we, as a small account, we don't have, $22,000 to collect all that, what we do is we're actually going to sell, like I just did right here. We would sell these 660s and then we would buy the one leg out. Boom. We get to collect this $288. Our max risk is $72. We just did a credit spread on the call side. We're selling calls because we think that the stock is not going to go higher. So that is the reason that you would do a credit spread on the call side, and the reason you would do a credit on the put side is because you think the stock's not going to go down. So we have a level down here on Tesla. We don't think it's going to get below this 575. All right, so we come over here. Let's say we don't think it's going to get to 575 really in the next 15-20 days. We can the farther we go out, the more premium we'll get. But the shorter time, we'll go to 30 days. So 570, 560. We collect $360. We pay $640. And as long as Tesla stock does not close down here by January 15th, we get to keep that $360. And you can do this every week. You can keep rolling them. If we want to go to the 9-week, the 580s and the 575s will collect $170. Our max risk is $330. That's how you take advantage of selling options outside of the money and basically just collecting income from options that are going to go worthless. As long as you're in the right direction. Now, if the price comes down, we haven't talked about this yet. If the price comes down and say you sold this outside of the money, now your max loss is going to be that $330. So if the stock just happened to blow past this 575 by December 24th and you were holding that contract, you're going to have to close out that put credit spread and you're going to walk away with $0. You're going to lose that $330. That's if things go the opposite way. All right. Why buy debit spread? Bullish. Okay, why buy debit spread? All right. Now, flip side. We did talk about this, but we're going to skim through this real quick. Why buy debit spread? A debit spread, like we said, you would actually want to buy that if you're bullish, whichever direction. If you're bullish, then you would want to buy a debit spread to take advantage of either the reason that the contracts are too expensive, or you want to be you want to have a more defined risk trade. You don't want to pay that extra premium. You don't want to lose the time decay. You're going to do a debit spread on the bullish side, or if you want to do a debit spread on the bearish side. So you would buy this and then you would sell this. All right, so that's basically breaking it down right there. In-out spreads. All right, let's talk about some in-out spreads real quick. Now, these are 50-50 trades, and out the money trades that we just talked about, those are about 70-30. Now, in-out spread, these are good. I really like these ones. And an in-out spread is basically one leg in and one leg out. So if you wanted to do a debit spread, one in, you're going to buy this right at the money and you're going to buy one out the money. Now, this is basically a 50-50 trade. This is basically saying we're going to pay at the middle of the contract. You're usually going to get filled at 50%. So that $5, divide that by 2 is $2.50. Now, right now, this saying it's about $2.33. So we're gonna pay $2.33 with the potential to make $267. This is probably the easiest way to double your money. So, say for instance, if you're like, okay, I'm bullish on the stock of Tesla. It's trading at this price right now. I want to get in. I'm going to do a debit spread right at the money. One in, one out. It's a 50-50 trade. As long as the stock goes up, I'm going to collect that money at the end of by expiration. If it goes down, I'm going to lose that money. It's basically 50-50. It's at the $5 width. $250 you can gain, $250 you can lose. You spend $250 to play, you lose $250 or you win $250. That's the in-out spread in a nutshell. All right, so I'm gonna wrap this video up. This video is 18 minutes. We're gonna go ahead and have a part 3. So I hope you guys like these videos. Part 3 will come out later. I dropped enough information on these 2 videos. I'm probably gonna do video 3 in a few days. I want to see how these videos how they're playing out. All right, YouTube, I hope you guys like this one. And Little Petty is parched, but